Our next speaker is yet another Earth scientist, so my apologies, everybody. We will move on to people who aren't Earth scientists shortly, but our next speaker is the fantastic, the one and only Mark Fellows, and he is going to give us a little bit of insight with regards to why he feels decarbonisation is energy security. Mark, over to you. Thank you very much.
Thank you, Sarah. That was a great introduction. Can everybody see my shared screen now?
We can indeed. Thank you.
Right. Okay. Well, before I start, I just want to say um, a really fulsome well done to the Oxford students. That was absolutely great. Really good and very heartening. Speaking as somebody who's getting a little bit closer to the other end of their career, I thought that was absolutely wonderful. And thank you for having me here today. I really appreciate the opportunity. So thanks to Sarah and the team for asking me. For those of you who don't know who I am or who Skarn is, we're recognized as the market leader in quantifying and benchmarking asset level energy use, carbon emissions, and water impacts in the mining sector. So we cover around 1,700, just over mines, smelters, and refineries globally across the full range of mine commodities. So for most of those commodities, we're covering well in excess of 90% of global production. And the data points that we focus on, as I say, are around energy use, carbon emissions, and water impacts. Our clients are mining companies weighted towards the larger guys, then a whole bunch of financial institutions, metal traders, and also end users and a few other market participants of various sorts as well. Besides that underlying data, we've got a very strong focus on the strategic aspects of sustainability. We're really thinking about being passionate. The business was really founded on a passion, particularly my own. I think that at the stage I was at in my career, I wanted to see sustainability fully built in and accounted for within mining company and financial institution decision making. And I saw this as a way of turning my background as a mining analyst, which is how I spent the majority of my career looking at the economics of the industry, but to turn that round and look at how specifically the economics of the energy transition were going to unfold. And it came from a really strong feeling back in 2020 that the energy transition was approaching a tipping point whereby it would become really unstoppable. And that's kind of what I'm going to talk about today as well. Right now, there's a lot of uncertainty, chaos, complexity, conflict going on in the world. And I thought that the title of this whole conference was very kind of provocative, which I think is the intention. I would say that none of us really right now can be getting too fixated on looking for stability. It's illusory. And if anything, my career has taught me that. What we should be focusing on is resilience. And it was great to hear the Oxford students name checking that as well. I think there's a realization, and it's almost like a form of stoicism, that there are certain things within our locus of control, the things that go on inside our heads. Everything else is completely outside our control. And the only thing you can really optimize for is resilience. So anyway, we can talk more about that maybe in the panel session. So in a world of complexity, can sustainable design reduce operational risk? Sustainability must create value or it won't happen. And it's not all about being green for its own sake. It's about energy and water security and social license to operate. So these are the kind of key, that's probably the three headline drivers that are in my mind right now. And so today I wanted to talk about decarbonisation and to what extent decarbonisation is actually really synonymous now with energy security. The two things are very closely linked. Let's just start by looking at a map of the world, and we've color-coded the countries here in terms of net energy importer or net energy exporter. So the exporters are in blue, the importers are in red. And what it shows you there is that you see, for instance, that China is a net importer of energy, the EU is a net importer of energy. It makes sense when you start to look at other areas of the world um, which are net exporters, and to some extent you can map the attitudes towards the energy transition and energy security based on this external energy dependence. And I think that drives an awful lot. And when you start layering on top of that, the kind of really acute issues we have going on now with regard to the Middle Eastern conflict, you can see that energy security is a massively variable issue depending on where you're located. But more and more, it's going to become a key driver of of not only national strategies, but also corporate strategies. And this also goes right back to the social license to operate. Are you taking, where do you get your electricity from? Are you going to be, as a miner, taking power from a power grid that's already overstretched? And or on the other hand, are you adding incremental clean power to a grid which needs it? And this almost kind of transcends the argument we hear so much, which is that the mining industry's got a free pass here because we're producing the raw materials that are essential to the energy transition. We don't think it's quite that straightforward. It's actually really important to look at where the energy comes from. So, looking at this through that energy security lens, there's a few examples here in terms of downsides and upsides. So the numbers we've highlighted are, in approximate terms, the annual revenue impacts of the issues that we've highlighted here in those two columns. So we've had a few examples recently where hydropower grids are being having their power supply cut short due to some kind of force majeure situation, a drought, for instance. So if we're looking at, say, the Mirador copper gold mine in Ecuador, the government has essentially said that they've got to get off the grid because there just isn't enough power to stretch them. Moselle aluminium smelter was recently unable to renew its contract. So basically that's shut. And then we have the Central African Copper Belt, where there's a drought been going on and the grid is extremely reliant on hydropower, and companies like First Quantum are being asked to ration their grid power draw. So in response to that, on the right, we have a few examples where we've got mining companies actually very proactively switching to their own secure power supply in the form of renewables. We've got Anglo American, which is a JV with EDF, building up their own wind and solar capacity. And then we've also got First Quantum again building up its own solar and wind capacity in the Copper Belt. And also an interesting example is the Nevada gold mines. And I think that really is quite, well, debatably, as much driven by energy security and a wish to constrain electricity costs as it is about some ambition to be sustainable or green. So I suppose really what we're saying here is there's a very clear energy security agenda going on. It has a very big overlap with decarbonisation, whether you choose to regard decarbonisation as the primary driver of it or not. One of the other interesting things that we're currently seeing in the markets is more and more substantive discussion about green metal price premia. We have a view that with initiatives such as the one being launched by the LME, the London Metal Exchange, to actually surface green price premium in the market and create a mechanism where those can be actually priced in, that there will be over time, and it could take a while, but there will be some means within the market to actually incentivize producers to produce lower carbon metal. Green premium do seem to be very much fixated on carbon intensity over and above any other sustainability metric. But it does seem that that mechanism is starting to happen, and we're also beginning to. I think interestingly, where a lot of that seems to be centered or fixated right now amongst the end users of these raw materials is on recycled content, and many of them seem to be quite fixed on the idea that recycled metal has to be lower carbon and therefore greener and better. The issue really there is that that's not always the case. And in an ideal world, even, there's never going to be enough recycled metal to meet all of demand by any means. We've heard some interesting quotes recently along these lines from some of the OEMs. We hear more and more that this has been particularly around recycling and carbon intensity is a real topic of interest, particularly in Europe, but it's gradually seems to be propagating out into the metal markets more widely around the world. The way we tend to look at this here at Skarn is, being a very data-driven bunch of people, we look at these things in terms of global carbon intensity rankings. So what you're looking at here is a graph which ranks copper mines globally in order of increasing carbon intensity from left to right on the graph. So the width of the bar is proportional to the amount of copper production. So the bigger mines have wider bars, and then they're all ranked in order of increasing carbon intensity. So on the left-hand side, you have the low carbon producers. On the right-hand side, the high carbon producers. And the one that we wanted to kind of highlight here, we've plotted a few of the recyclers, the secondary plants, onto this curve as well, and that's something we're building out now. But there was in the news recently a Rubis and Kamoa copper mine, and were publicising the fact that they have created a green copper supply route in conjunction with Trafigura, and it does indeed plot up on our curve as being very low carbon intensity for a primary copper mine. But when we look at the secondary copper facilities, you'll see that those have tended to plot up at the lower end of the curve as well. The point being, though, that it's possible to have a primary copper production source that is highly competitive in terms of carbon intensity with the secondaries. In the case of the secondaries, much really hinges on the actual source of the electricity that's going into that secondary plant. So it's not as simple as simply saying it's recycled copper, so therefore it must be lower carbon than everything else out there. It's not necessarily the case. You've got to quantify these things, and you've got to have a consistent methodology for doing it, which kind of comes back to that green price mechanism. If we're going to have some kind of premium in the commodity markets for low carbon commodities, there's got to be a consistent methodology applied to quantifying that carbon intensity. And right now, what we're seeing is a lot of the friction and the stickiness within the supply chain when it comes to agreeing a green price premium is actually down to various actors within the supply chain not using a consistent methodology from one to the other in terms of how they're quantifying that carbon intensity. So we have some pretty clear ideas about how that can be resolved, and we're working on that. But we think that initiatives like that could actually significantly move the dial in terms of getting all of this moving. Moving on and looking at how a couple of example mining companies, how their emissions are distributed within their production base. Um, we wanted to get across the point that it's really important that we look at how a mining company's emissions arise at the mine by mine level. So we've got two examples here, one of them being Agnico Eagle, gold producer, and another gold producer, Newmont Mining. And the Agnico chart shows it on an asset level and the Newmont on a regional level. Both are useful in trying to assess where the energy risks are. Um, and I think you have to take into account that both of these companies have interim decarbonisation targets, but it's not enough just to be meeting the targets. It's what are you doing and how much impact is that going to make? By delivering on a decarbonisation target, will it also, to some extent, de-risk your energy supply? And so we've been asking our clients to look at it from this perspective. Look at what your consumption of fossil fuels is. Mine site scope 1 emissions are primarily down to diesel consumption in mobile equipment. So there's going to be a big, interesting shift going on in this industry over the next 5 to 10 years in terms of electrifying mine equipment fleets. We're going to start to see that rolling out in the next few years. There's already lots of things happening. So far, what we've seen is that most of the movement, most of the decarbonisation that companies have achieved has been down to them reducing their scope 2 emissions through securing power purchase agreements. And there's an interesting situation arising now whereby the GHG protocol may well reclassify the way that those location versus market-based emissions are quantified, which could set an awful lot of companies back in terms of their actual stated achievement in decarbonisation. When we look then at say a range of mining companies here, what we see is that most of them, if not all of them, have got some kind of decarbonisation target. The rate of progress they're making against those interim targets, so most of these are 2030 targets, is very variable. And just to say, we're not trying to make some kind of watertight comparison here, because there's a lot of variation in terms of how these targets are stated. But what we're showing is that in terms of what's already been completed, there's a massive spectrum there. If we look at some of these companies, they're already a long way along in terms of meeting those. Other companies have still got a long journey ahead of them. And in terms of the levers those companies are going to be pulling to try and achieve those targets, the point of this slide here really is to highlight the fact that those renewable PPAs are pretty much the core of most companies' efforts. Next to that, they're looking at renewable power, and they're also looking at doing what they can at the margin to decarbonize their mobile equipment in terms of renewable diesel and increasingly electrification. Just to kind of round off here, I wanted to just very quickly show you that we've started looking at what the economics of decarbonisation look like. We've put together a scenario model whereby we've looked at two different approaches to quantifying the costs of abatement, and this relates to the copper mining industry. The top chart on the right here, we asked the question, if we manipulate a whole load of parameters and execute only the decarbonisation initiatives that have a net positive financial rate of return, what would happen? And in the bottom chart, we're looking at the other end of the extreme, where whether it's economic or not at the present moment, given the costs of these technologies, what would it look like? And what you can see there is the impact of the two scenarios are very different. One of the interesting things really to point out is that the light blue bars represent renewable energy installation, and in many jurisdictions, the economics of that already look very positive. Um, the other point I wanted to get across here is what really counts and what really matters is that decarbonisation technologies are not looked on as a standalone that you can just drop into an operation and expect to necessarily stand on their own 2 feet in terms of return on investment. What's also really important here is you have to look at the wider holistic impact on the whole mine plan over the life of mine and the potential advantages you can get in terms of things like reduced cutoff grades, the ability to shift lower grade material at a lower incremental cost, and factor that whole thing into the life of mine plan before you can make a real true decision in terms of a decarb technology and its viability. And right now, that's even more difficult given that those technologies are still, in many cases, pre-commercial launch, and we're all taking a bit of a guess in terms of what the actual costs are going to be to implement them. So anyway, that's about as much as I've got time to say. I'm very much looking forward to Q&A and to the panel discussion, and I'll be quiet now for a minute.
Brilliant. Thank you very, very much, Mark. Everyone, please put your hands together for the fantastic Mark Fellows. Now, Mark, unfortunately, we don't have much time for Q&A, even though there are some sparkling questions that are coming in the chat. I think just one before we go straight across to Isabel, and I know that Aileen will be sharing that screen for Isabel. And that is around, it's not just about the decarbonisation. So a question with regards to the DRC, I worked there for a little while, and one of the questions was all about there wasn't a lot of energy going around, and who should get it? Should it go to the mines, which were generating jobs, etc., or should the energy be available for the local populations? So I'd be really interested to know that with regards to the stats for Kamoa, is that them generating their own power? And if so, how are they doing it? Or are they drawing from the broader energy provision in the area? Because some of the mines do draw from the broader area.
And that really is the issue. The reality is that the grid does not have the excess capacity to do that. So I think the answer should be that the onus should be on the miners to actually generate their own power. And I think more and more in remote locations, the economics of doing that are going to tip more and more in the miners' favor anyway. It's in their own interest to have energy security in the unstable world that we now inhabit. And I think this is going to be one of the mega trends of the industry over the next 10, 20 years is owning your own generation. And when you start thinking about things like modular nuclear reactors, let alone wind and solar, it's going to be really interesting. But I think more and more miners are going to wake up to this. And there was a really interesting comment made last week by Robert Friedland about energy security, and he said that any mining company now should be aiming to make sure they've got a year's worth of diesel stocked up, which I thought was really interesting. My view on that is, well, put some solar panels and a modular nuclear reactor in and electrify everything. No more carbon emissions, no more energy insecurity. And I think that logic will play out, particularly as the cost of those technologies plummets, which it will.
Yeah, no, absolutely. And I think we've seen a lot of the mines, say in South Africa, move across to their own power generation because they haven't been able to rely on the grid that they have, for example. But then, of course, for an alumina smelter, such as what you might find at Maputo or in Hillside, there's a really good piece of information that's come in the chat with regards to that. It's fascinating because I think as well from a Mozambique perspective, most of that energy comes from hydroelectric. But if they haven't managed to land the contracts, then that's a problem. And for an alumina smelter, you need huge power.
You do.
to do that with very little interruption. I think they can go down for what, 3 hours before they have really big problems in
Yeah.
terms of keeping the operations going. So anyway, as you can probably tell, Mark and I could speak all day with regards to this. Mark, I point you to the chat and to the questions. Thank you so, so much. Absolutely
Thank you.
brilliant. Round of
Thank you again.
applause.
Bye.
Fantastic. Excellent.